So our simple example starts with the idea that you form a company. So this new company, I'm forming it. I buy just one asset at this point to form the company, and it's an investment property for $950,000. So the business idea here is to generate rental income from my investment property. So I buy a $950,000 property, and I finance it with a $100,000 5-year bank loan at a 5% interest. It's secured with first liens on all the property, receivables, equipment, and inventory that the company might have. At this point, it's only just that one property. But the notion here is when you go and you borrow money from a bank, you can get secured lower interest rates if you go to a bank as opposed to sort of issuing a bond, primarily because bank debt is often secured by collateral. And in this case, I've been able to secure $100,000 with a lien on sort of a general lien on all the assets of the company. So this is sort of a typical kind of collateral that you would see when borrowing money. I also get a second loan because $100,000 isn't enough to give me the whole $950,000. I get a second loan, $400,000 with it's a 7-year bank loan at 7% now. And the reason why they charge a higher interest rate is because it's now secured with those same assets, but now it's secured with a second lien. In other words, if there's anything left over, if there's any collateral value, these guys are second in line on the assets above. But as we'll see shortly, this loan is still secured. It's just a second lien loan, which means it's better than an unsecured loan, but it's not quite as secure as a primary lien. And so that gives me $500,000. The remainder I fund with my own money, presumably equity, as I am the owner of the business. So the remaining $450,000 I secure with my own equity. So this is what a simple balance sheet, might look like here. And you see you've got on the left side of the balance sheet, you have $950,000 in assets. It's that investment property represents the only asset you have. Obviously, once you borrowed the money, the $100,000, the $400,000, you were able to get the cash that you instantly here. We didn't turn this into a 2-stage process. You just instantly turned around and bought the investment asset. So hopefully that makes a lot of sense. One sort of fine point here is I've put in $450,000 of my own money. I incorporated my company, and when you do that, you actually arbitrarily issue yourself a certain number of shares. So how much is each share worth is kind of an arbitrary decision upon incorporation. If you issue yourself 90,000 shares, say, then at a 450,000 initial value, under GAAP, you would record the value of each share as $5 per share. So $5 times the 90,000 will get you to 450,000 shares. Of course, if I issued myself 180,000 shares, it would have been 250. That becomes arbitrary in the beginning, and it's a function of how much you put in and how many shares you've arbitrarily issued yourself. So now let's continue with this simple example. So that's pretty straightforward. So now I immediately find a tenant, and I realize that I should probably have some cash on hand for everyday maintenance. So I put in another $50,000 of equity, which buys me 10,000 shares, at least on paper. If each share is worth $5 per share, I've got 10,000 new shares if I put in $50,000 of equity. What does that give me? A debit of $50,000 in cash. And of course, now my equity value has gone up a little bit. So now slightly bigger adjustment, here, or an adjustment, a debit, and a corresponding credit on the equity side. And then one other bullet here is I also purchased flooring from a vendor that created a payable of $20,000. So presumably I want to do a little bit of I want to put in some hardwood floors. So I didn't want to pay for this in cash yet. I owe this vendor $20,000. So I've got a credit for payables of $20,000. Of course, I've got this flooring that's sitting as an asset now that's bumped up my total asset value up to $1,000 or $1.02 million. Remember, at $5 a share, the extra $50,000 gets me an additional 10,000 shares. So now I've gone from 90,000 to 100,000 shares. Again, so far, hopefully, I think we're straightforward. Now, some time has passed. Business is good. Rental income is flowing, and my balance sheet now looks like this. So I've got some profits have been generated to retained earnings, right? So when you generate profits during the year, that flows to equity as well. It's not the same as common equity, but it flows to equity, bumping up your total equity to 540, and that increases my cash from the prior 50 to 90. So hopefully that makes sense. I also now seek to do a large renovation, and I estimate that I need an extra $150,000. So instead of taking on more debt or putting in my own capital, I decide to issue equity to others. So this is where it gets slightly more interesting. So now I've decided I want another $150,000. I want to generate more rental income. The way to do that, big renovation that's going to jack up rents. Okay, so how many shares should I issue? So now we're getting into a slightly more interesting question. Recall that I initially valued each one of my 100,000 shares at $5. So now suppose, as I'm trying to figure out, because I got to go to the public now, or presumably I have to go to some investors and ask them to give me $150,000. What's the right valuation? So I retain an investment bank, and you have to kind of go with me on this. Obviously, when you're talking about a business this small, you're not going to go to an investment bank, but you can certainly imagine, just for the sake of this illustration, if you're running a company, it's sizable enough, you go to an investment bank and they're advising you on this equity offering. And they're advising that, assuming that I successfully do this renovation, right? They're trying to figure out what is the equity going to be worth. And assuming that, if you're going to get this 150,000 and you're successful in getting all this stuff done, they're crunching the numbers, trying to figure out what that business might look like now that it's generating those higher rents. And they arrive at the notion that maybe the equity value is around 900,000, right? And we're going to talk about this a little more specifically in just a minute. But the investment bank, and trying to figure out what investors might be willing to pay, they're not really thinking about the value of your business in terms of how much equity you originally put in. They're trying to figure out the value of the business in terms of the rental, the present value of the rent that you can generate. What is that business worth as a function of the future rents you can generate? Well, they came up with a number of 900,000. We'll talk about that number in just a second. But let's say they came up with that $900,000 number. And so if the business is worth 900,000, not 540,000 as it appears on paper, right? How many shares do you have to issue in order to get $150,000? So why don't you take a moment and try to actually figure that out on your own? How much money do you need? How many shares do you need to issue in order to raise $150,000, given that, let's say, everyone believes your business is worth $900,000?